Hello friends, my name is Pinaki and welcome to my channel FinTech Logics. So today we will talk about another type of debt mutual fund which is liquid funds. So if you remember, we have already covered about overnight fund. If you have not seen that, I'll provide the link here. Please have a look. Now primarily we will talk about the concepts, when to invest, and the strategy to get in and out. So let's begin. Now we will stick to our skeleton here. So this is applicable for all age groups and with a specific goal of short term savings. So primarily we are looking at 1 to 2 months of period, and when we have an immediate need to fulfill, immediate need in 1 2 months to fulfill, only at that point of time we should be choosing this mutual fund. Now why I'm telling that, I would cover that in the later part of my video that has got a lot of implications of tax. That's what. So let's describe the other items of instrument and strategy with the simultaneously looking at how to choose a liquid mutual fund from any investment site. Now, the first one regarding this is that you will go to a debt uh, a mutual you'll go to a mutual fund place, and then you will select debt mutual fund under that, and category should be liquid. Now once you choose a liquid mutual fund, you would be shown with multiple options. So this is something dividend type that we talked about is growth option. So now in the instrument you have cognitively chosen a direct fund, and then you are going for a growth mutual fund. That means you want your amount to be reinvested. Now the next one is about your non and less volatile fund. So when you look at the graph, you would see that we would specifically look at expense ratio to be low, because expense ratio would limit our investment value. So rather we should be choosing an investment uh, of expense ratio which is typically between 0 to 5%. The lower the expense ratio is, the better for better is it for us. AUM value, asset under management value, the higher value, the less riskier the asset is. So we should be going for that. And we should also be paying attention to the CAGR, that means the annual growth rate, which is for 2 years and 3 years period. And as per the increase pattern, if it is more, we should be normally choosing those kind of mutual funds for investment. Now, one more thing that we should be looking at is the minimal exit load. So, normally the exit load would be between 0.1% to 0.7 or 0.8%. The lower the exit load is, the better for us, because we want to get out in 1 2 months and we should not be charged with much exit load. Now, when we talked about volatility angle, we have to look at the graph pattern. So the linear graph shows that there is less volatility here, and we should be normally going for those funds so that our our investment would be safe. Now if we look at the strategy part, the strategy is that we should be systematically investing in and systematically withdrawing out. So that means we can set every month on a fixed date investment. If you are doing for going for SIP or lump sum is good. And while withdrawing, we have to pay attention towards tax, because this is a debt mutual fund and the gain is taxed on our income slab and not as per your short or long term gains in equity mutual funds. So that is why I said that if we have an immediate need, then only we go for this kind of investment, so that our investment value is preserved, capital is preserved. I hope now you get a feel of how to select the mutual fund. So primarily, if you see, these funds are secured because primarily it has invested in government equities and CDs and treasury bills. So primarily These are backed by government and very less risky. That is why we should go for this kind of investment. Otherwise, equity mutual fund is lot more advantageous than these mutual funds. So thanks a lot, viewers, for watching my video.